I now hand the conference over to Mr. Arpit Vyas, Global Managing Director. Thank you, and over to you, sir. Mr. Vyas, I would request you to please unmute yourself and go ahead. Mr. Vyas, we are not able to hear you, sir.
Arpit.
Ladies and gentlemen, we would request you to please stay connected while we check the line for Mr. Vyas. Ladies and gentlemen, thank you for patiently waiting. We would request you to please hold the line. We are trying to connect the chairperson to the call. Thank you. Ladies and gentlemen, thank you for patiently waiting. We have Mr. Arpit Vyas reconnected to the call. I now hand the conference over to you, sir. You may take it forward.
Thank you, moderator. Dear all, welcome to the conference call of DCAM. First of all, we all would really wish and hope that all of you, your family members, your friends, and your loved ones are keeping safe, in good health, and have not been affected negatively by this second wave of the pandemic. We implore you to keep safe and please make sure that simple and basic hygiene is followed by all of us and the people around us. We as a company have had the misfortune to see some of our dear colleagues pass away and many family members of many dear colleagues as well. It is heartbreaking for us, and we are doing everything we can as a company to support the family of the affected. We have recently done a tie-up with a reputed hospital where all the colleagues of the company, along with their family members, will get a fast-track line for getting vaccinated at no charge for whoever wishes to get one. The dear colleagues who have lost their lives, the company has decided to keep paying their monthly salaries for supporting their families for at least 2 years. The company will also further communicate with the grieving families to see how best we can further support them in the things like education for children, etc. It is evident that the fear is not for the virus so much, but more for the lack of the treatment. We are also working on developing in-house capabilities to be able to help the affected colleagues in case we are not able to procure the hospital beds in time. For that, we have sent 10 high-flow oxygen concentrators from Switzerland as a start. These are very uncertain times, and we are adapting and responding constantly to the daily challenges and situations at the best of our abilities, and we wish the same for you. Now, a short update about the progress of the company from the last quarter and for the full year. India has started picking up from this quarter as the numbers are reflecting. The two virtual audits done by the clients that we mentioned in the last quarter. One of the clients has been able to successfully get the approval from their local regulatory authority based on just the audit report. This is indeed very good news, extremely encouraging and motivating, reassuring for both the company and the client, and we are wishing to be sure that it is the same for you as well. They have also placed the orders for the requirement this year and at a much higher price than the previous orders. The other client is also confident of achieving the same with their local authorities, and we will be forcing their orders as well, hopefully later on in the year. The current pandemic situation is creating a tremendous challenge for us in terms of recruitment, but as always, the people are working extremely hard to close the gaps as fast as possible to the best of their abilities. The challenge continues to the engineering and tech upgrades as well that we have planned, and the things are moving slower than desired. All said and done, we are slowly but surely moving in the desired path, setting strong fundamentals for the long-term future of this company. We have started validating SAP, and we have evaluated, chosen, and started to implement a huge quality system management software, which will be our ERP for quality and document management. By validating SAP and implementation of the quality management and documentation software, 80% of the CAPA will be catered to. We have a lot of orders in hand, and some customers have not only increased the prices of their orders but paid 100% advance to book a manufacturing slot. In all of this, Naroda has been a tremendous support and shown like a star. Being a disinfectant facility, we are certain that it has helped in some shape or form through its customers for managing the pandemic globally. France, the construction is going on very well for the new formulation facility, and we are so excited about that. Switzerland, all of you must have read about the joint investment of 15 million Swiss francs that has been signed between Carbogen Amcis, Switzerland, and the client for their product. It is one of the largest co-investments that we have ever entered into. We are extremely excited to see the potential of this relationship. Switzerland, as mentioned in the last quarter, has completed a record-breaking year, close to 160 million Swiss francs of revenue. This is the highest revenue in the history of Carbogen Amcis' existence. We are extremely proud of our colleagues and congratulate them with all our heart, and will be undoubtedly planning to celebrate this achievement very soon. Netherlands has done better than expected, and so has UK. China has achieved another milestone by achieving a 22% EBITDA and becoming profitable. We have set sail in the desired direction, and we are excited to see its journey. We are extremely thankful for the support given by many of our customers during these challenging times. Their support is not just in terms of money, but helping us technically with the regulatory, and most importantly, showing their faith and trust in us in the new mission and vision of that the company has, positively overwhelmed us and motivated us beyond imagination to achieve the excellence that we have longed for. This exact same thanks we would, without a doubt in our minds, extend to you all as well, our investors, colleagues, their families, and all of them globally. Thank you, and with that, I would request Mark to say a few words. and then post that, Harshal to update on the numbers. Thank you.
Thank you, Arpit. Thank you for that very comprehensive introduction. I would like, first of all, to welcome all of you, wherever you are in the world today, to our con call, and I sincerely hope that you're all safe and that you're well. As Arpit mentioned, we are continuing to work through our issues with the EDQM. We have been quite successful in moving a number of projects over to our Naroda site, and we've been able to increase the throughput and the revenue of our Naroda site, which is a very encouraging state of affairs. The COVID issues, unfortunately, have impacted us significantly in terms of how we work. As you will appreciate, we're a global business and we're used to all working together, traveling to see each other, debating, conferences, meetings, etc. And although we've been able to cover a lot of that by video and things like that, it doesn't replace the fact being able to put bodies on the ground in our various locations and work through our issues. So that is continuing to impact us, and hopefully as we start to emerge out of the restrictions imposed in Europe and the West, we also hope that India will recover and we'll be able to start working together again in the way that we've always been used to. The market remains continuously very buoyant. There is competition out there, but we are still successful in selling our excellent service and our fantastic capabilities. As you'll see from the highlights in the investor pack, we have been able to sign a long-term agreement for co-investment with a customer in Japan to produce their linker and payload. We are exceedingly excited about that project, as Arpit said. It's taken a long time with a lot of efforts from people all across the Carbogen Amcis group to make this project happen. And we've fruitfully signed the deal to enable us to co-invest and to put the facility together to manufacture that commercial linker and payload. We also have a number of other interesting things cropping through. You'll know that our vitamin D business, we've been looking and investing in time and effort in ways that we can continue to sustain that business. We are very close to being able to publish results from a number of trials that have been carried out, as I mentioned at the last con call. That's been very good. Our cholesterol sales have been much better than we had anticipated. Not really very easy to do for our sales team up there, but they've been able to stimulate new customers and to fill the gaps that we had from one customer, previous customer, manufacturing his own cholesterol. And as a result of that, the numbers remain very strong there, and that enables us to continue to invest there to develop new products. So I'm sure there'll be lots and lots of questions about the various parts of the business. So I'm going to hand over to Mr. Harshil Dalal, our global CEO, our global CFO, to talk you through the numbers, and then we can get to the questions and answers. Thank you very much. I look forward to the questions, and over to you, Harshil.
Thank you very much, Mark. A very good evening to everybody. Hope you and your families are safe and are doing well in these trying times. I would like to present to you the financial performance for the quarter and year ended 31st March 2021. For the quarter, we had an income from operations, so that's our revenue of 529 crores as compared to 512 crores for the comparable quarter last year. So which is a growth of about 3.4%. So even though India did not contribute much to the consolidated revenue, because of significant uplift in the performance that we saw at the subsidiary level, the income from operations were higher than what they were in the comparable quarter last year. The costs for the quarter were 166 crores as compared to 136 crores in the comparable quarter. Employee expenses were at about 220 crores as compared to 200 crores, while the other expenses were at 55 crores as compared to 68 crores. The EBITDA for the quarter was at about 16.7%, and in absolute terms at about 88 crores. as compared to 21%, equating to 107 crores for the comparable quarter. The depreciation and amortization that includes the amortization on the goodwill that we have on the standalone India business that was at 76 crores, while the finance cost was at 9 crores as compared to close to 20 crores in the comparable quarter. Two important points in the current quarter's performance. We had an exceptional item for the quarter. This was on account of write-off of inventory for one of the customer projects, which did not move forward. So that entire impairment of the inventory has been accounted for in the current quarter. So that amounted to about 22 crores. Number two, because of the recent amendment in the Income Tax Act as far as India is concerned, the goodwill, the depreciation on the goodwill is no longer an allowable expense as far as the tax books are concerned. So what we have done is that the deferred tax liability on account of this allowance for the future has been written off, or a provision has been made for the same in the current quarter. There is obviously no cash outflow on account of this, and what would happen is that as we keep on depreciating the goodwill in the books to the tune of about 89 crores each year, as we have been doing for the past 5-6 years, a portion of the deferred tax liability would get reversed, and that would be a positive impact on the tax in the current financial year and going forward. So these were the two important points to be noted as far as the quarter is concerned. For the full financial year, our revenue stood at 1,912 crores as compared to 2,043 crores. There was a decline of about 6%. But obviously that was driven by the decline in the revenue from India, and the story as far as the subsidiary performance is concerned for the quarter, the same story stands true for the full year as well. The employee expenses showed an increase by about 14.5%. This increase also includes an impact of forex. So there was a significant movement in the foreign exchange rate for Swiss franc as well as the US dollar as compared to the last financial year. And as you know, most of our employee cost is in Swiss franc because Switzerland is the one where we have most of our employee expenses sitting. There was a negative impact on account of the forex fluctuation, on account of the translation of the employee cost into INR. The other expenses stood at 296 crores as compared to 325 crores in the comparable year last year. The EBITDA margin for the full year was at 14%. That was about 274 crores as compared to 24%, equating to 497 crores for the comparable year. If we ignore the forex impact, the EBITDA stands at 302 crores, representing close to 16%, as compared to 467 crores in the comparable year last year, and that represents about 22.8%. The two items that I mentioned for the quarter, obviously those will stand true for the full year as well. And those are the reasons, why we have a negative impact for the current financial year. Having said that, as far as the cash profit is concerned, we had a positive cash profit of 278 crores for the full financial year, which translates into a cash EPS of about 17.7. Some of the other highlights that I would like to mention is that, as you would have remembered, we did an OFS, that is an offer for sale, in the months of December and January, December 2020, January 21. The total amount raised was close to about 85 crores. we are happy to mention that about 72 crores has already been infused by the promoter shareholder into the company. So that obviously improves the liquidity, and we were able to return some of the old outstanding advances. The capex for the year stood at $49.3 million. As you are aware, we are undertaking massive expansion in Switzerland as well as in France, one for enhancing our capacities as well as forward integrating our business. So most of the capex has been incurred in those two geographies. Having said that, the net debt as on 31st March 2021 stood at 101 million, which is more or less similar to what we had as on 31st March 2020, which was at 100 million. I think I've covered most of the financial highlights for the year and the quarter, and would be happy to answer any questions that you might have. With this, I would like to hand over the call to Mr. Sanjay Majmudar, our Independent Director.
Thank you, Harshil, and good evening to all. Of course, we are in very challenging times because of the second wave of COVID, but it seems, going by the indications available, that this second wave is likely to normalize very soon, hopefully by the end of the first quarter, and we wish that everybody remains safe. I think very quickly, Harshil, just 2 points I want to highlight, specifically even at the cost of being a bit repetitive. One, as Mark and Arpit mentioned, Bhavla has, I would say, come out of most of the issues relating to the EDQM, and it is just a matter of process. Approvals have started to come from most of the key European customers who have concluded their audits, and we should see the ramp up happening. The only slight negativity is the fact that the speed of ramp up may be slightly impacted due to the negative effects of the second wave, but hopefully from second and third quarters, Bhavla should start resume its near normalcy in terms of operations. So that's one major problem which is hopefully behind us. Second, Harshil explained about 100 crores of extra DTL, deferred tax liability provision, which is a non-cash outgo, which happened in Q4, has shown that the bottom line has been impacted. This is a very technical provision required under the Ind AS because of the fact that since the goodwill is now no longer tax deductible in terms of an intangible asset depreciation on goodwill. As per the Ind AS, this one-time DTL has to be provided. I think this is one time only, and as Harshil explained, over a period of time this will be reversed and it should be normalized. I think we are quite hopeful that we should see 21-22, if not absolutely normal, I would say near to normal, that is the the COVID-19, that is the closer to 19-20 in terms of the overall performance. But of course, it is a bit premature for us to give any specific guidance. But two things I'm sure we will see: definitely some growth in terms of top line and a remarkable growth in terms of bottom line, with the expectation that both in terms of EBITDA as well as in terms of PAT, it will be a much better improvement in 21-22. I think with this, let's throw the house open for Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Anyone who would like to ask a question, please press star and 1 at this time. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Sajal Kapoor from Unseen Risk Advisors. Please go ahead.
Yeah, hi, thanks for the opportunity and good afternoon, team. Just a couple of questions. So in the past, Dishman Carbogen has done some vaccine formulation, I suppose from your UK operations here in Manchester, if I'm not mistaken. So the question is there any COVID-19 vaccine CDMO opportunity we are currently working on or discussing with our potential partners?
No, generally speaking, not directly with vaccines. What we're talking about are some of the vitamin D analogues may appear to have some efficacy in certain areas. But we're not a vaccines company per se. So there was a potential opportunity with some of our cholesterol, but unfortunately they need a fully synthetic based cholesterol, and ours is, although many thousands of times back in the synthesis, is derived from sheep wool. So no, we're not a vaccines company. Our focus on COVID is the disinfectants and some of the vitamin D analogues, which are the subjects of the trials that we've been carrying out, as I've mentioned before.
Sure, Mark, that's helpful. And secondly, when it comes to ADCs or antibody drug conjugates, how would you rate Dishman Carbogen's capability vis-a-vis someone like Piramal Pharma?
That's a really good question. There were two companies that founded, if you like, this ADC business as a service. One was Piramal and the other one was Lonza. I think Lonza probably have the largest capability around the world at the moment. Piramal has faded away a little bit, but not because of their lack of capability in ADCs, but their overall profile in API development. We came along in the second wave. What we've been able to do is to add quite a bit of additional technology and capability. The biggest deal for us in ADCs is not just our capability in ADC, but our capability in all the other things that surround the drug conjugate. And one of the things I'm very proud to say is that we're in the top 5% of companies that are out there who can do the linker payload. And the linker, if you remember from our many discussions about ADCs, is probably the most complex part. And we are truly experts in working on those very complex pieces which link the antibody to the drug. So that's where I think, in terms of overall ADC, Lonza are probably in the lead with their capacity and their 15, 20 years of experience. But we are probably as good as they are in the linker capability, maybe even a little bit better. And with our overall capability, I think we compare quite well. So that's my personal opinion of the market. There are, of course, other companies getting involved in this now, of course. So there are companies who are saying, right, we see a lot of activity here, we're going to get involved. And that's what happened when we moved into hypo in 2002, into potent compound. We were one of the first 2 or 3 companies really to do it seriously. Now many companies claim to do it, but claiming to do it and being able to do it are 2 separate things.
Yeah, absolutely. And looking at our pipeline, Mark, I think there is still a reasonable amount of development work. I know recently we have gone commercial with one ADC, but I think there's a lot in the development as well. So the pipeline looks pretty healthy from an ADC perspective, right?
Yes. I mean, generally speaking, to be perfectly honest, at the Carbogen Amcis boundary, the pipeline is incredibly healthy. And our challenge is to get through the work and progress it and then capture more work. And a large proportion of that is in the oncology field, as it has been for about the last 10 years. And part of that, of course, is the drug conjugates. So, yes, I think it's reasonable to say that the pipeline is very healthy and the team's very busy.
Sure. And I've got one financial question as well, maybe for you, Harshal. Looking at our historic gross margins, CRAMS, generally speaking, is about 75% thereabout gross margin business. We have historically achieved 80% plus gross margins as well. in Q4 this fiscal FY21, the gross margin is one of the lowest we have seen in recent days. But I think that's more of an aberration, and come FY22, we should kind of mean revert to the gross margins. I know Sanjay Majumdar alluded to getting closer to the 2019, fiscal 2019 financial benchmark by the end of this fiscal. But yeah, if you could just help me out with the gross margins and the operating margins for this year. Thank you.
Sure, Sajal. So Sajal, basically, in this last quarter, there were two things which actually drove the gross margin down. But, as we have been saying, we are a company that should be kind of compared on a quarter-to-quarter basis, but more so on a yearly, if not a bi-yearly basis. So essentially what happened was that, one, in Netherlands, the higher proportion of sales was contributed by the cholesterol segment as compared to the vitamin D analogs. So just to give you an idea, as far as the margins are concerned, the analog margins are almost twice of that of the cholesterol business. So since there was a higher portion of cholesterol, which was driving the revenue, it obviously had an impact on the overall cost as a percentage of sales. Number one. Number two, in Carbogen Amcis, some of the development, so the development revenue that is at a lower margin as compared to commercial. So we had a higher amount of share of the development revenue in this quarter as compared to some of the other quarters in the current financial year as well as in the comparable quarter last year. So these were the two reasons, why the cost looks higher than, as you correctly mentioned, what historically has been our cost. So on a yearly basis, our margin, if you see the costs are at about 25%. So we are usually in the range of about 22 to 25% as far as the annual costs are concerned. So that is something that we are more or less in line with.
Yeah, so FY19 numbers in terms of the margins, I mean, are we likely to get closer to those by the end of this fiscal?
Yeah, so by the end of this fiscal year, obviously as the operations in India keep on ramping up, so should be our margins at a standalone and at a consolidated level. So obviously, we should be getting there, I would say sooner than later. But yeah, I mean, it would keep on progressing as we get through the quarters and as the revenue from India operations keeps on increasing.
Yeah, sure, but at least can we expect 75% gross margins? Because March 2019, our gross margins were about 76% plus and operating margins were 26%. Is it?
Yeah, so on a gross margin basis, yeah, it would be reasonable to assume that, we would be at about 75 to 77%.
Right. Okay. I'll rejoin the queue. Thank you.
Thank you.
Sure.
Thank you. The next question is from the line of Vishal Manchanda from Nirmal Bang Institutional Equities. Please go ahead.
Yeah, thanks for the opportunity. Could you share a guidance for your CRAMS India business for FY22?
So as far as the India CRAMS is concerned, as Arpit also mentioned, we are getting approvals from many of our CRAMS customers, either by way of remote audit or otherwise. So the revenue should keep on increasing throughout the course of the current financial year. As far as the guidance is concerned, it might not touch the level what it was in financial year 19 or actually financial year 20. But, we should be at least 70 to 80% of that level.
Okay. In as much as India CRAMS are concerned.
Yeah.
Okay. Is there a downside risk to this 70 to 80% of FY20 numbers?
Well, the downside risk, obviously, we are getting the approvals. I mean, if there is a delay in getting some of the customer purchase orders that we are expecting, or the COVID situation actually worsens than what it is right now, in Europe or in some of these other countries, etc. That could be the only risk. But otherwise, about 70% of FY20 should be pretty much achievable.
And how should we look at CRAMS Switzerland in FY22? So do we have capacities to build growth from where we are today?
Yeah, we're continually on a program of capital expansion, relatively smaller scale to bridge. If you remember from the previous con call last quarter, we've got a number of what we call bridging projects, which enable us to bridge the time between now and when the larger facility will be completed in 2 or 3 years' time. Those projects will liberate capacity. The other thing that we always bank on, and it's just the nature of the business, is that things die. So that's why the strength of the pipeline is so critical, because if you have a strong pipeline, when a project dies in the clinic or the customer decides to prioritize another project, we don't suffer adversely. So we're able to bring another project forward and be able to keep our pipeline moving. So yes, there is capacity. I'd love to have more. However, we do have areas where we do have capacity. So Shanghai, which we mentioned before, is now positively contributing towards the growth of the business. Shanghai has some headroom, which is really good news. And we have R&D headroom in our Basel facility as well, with an excellent R&D team. So we have areas where we have capacity and we can focus our efforts on that.
Could you share the constant currency growth for the CRAMS business during the year, Switzerland CRAMS business? So on a rupee terms, it grew 18%. What would it be in Swiss franc terms?
So that would be about close to about 8%.
Okay. Can you also share the same thing for the Netherlands business, vitamin D and cholesterol business?
So that on a yearly basis, that would be so our yearly growth, as reported, is about 5%. So on a constant currency basis, it would be more or less flattish to what it was last year.
Okay. And just one final, what was the split between development and commercial revenues for CRAMS in Switzerland this year?
So that would be... So for the full year, it would be close to about 60% development and 40% commercial.
Okay. And if it moves in favor of commercial revenues, the gross margins should expand.
Exactly, but then there will also be addition of new products for development because obviously we would want more products so that more can become commercial in the future as well. So overall, on a margin front, maybe 1% or 2% that could increase, but otherwise, this would be more or less the ideal proportion.
Okay, so 60 developmental and 40 commercial is what would continue in the future too?
Yeah, I mean, it might be 55-45. And Mark, maybe you can also mention what you think, but I think maybe around 55-40.
Yeah, historically, we know that if the ratio between commercial and development goes outside of the 40-60 either way or the 50-50 either way, that we have a bit of a problem. It's really, really important to recognise that the development work is future commercial work. And if you don't do that and you prioritise the commercial work, one day you'll find out. So, although we make money on the development projects, they earn us the right to make the money on the commercials. So you have to earn that right by doing the development work. And a perfect example would be the project we just signed the deal on with the co-investment. That's a perfect example of how it works. If we had not worked on development with that customer, we would not be getting the commercial supply of that linker payload. We would not be getting that commercial supply. End of story. And a lot of customers work that way. Not all, but a lot of customers work that way.
Are validation revenues?
It's 50/50.
Got it. Pardon?
Validations would be development.
Okay, yeah, that was my question. Thank you.
Yes, validation is development. Commercial is when we're under a commercial supply agreement and we're routinely manufacturing on a forecast based from the customer every year, and we have a 3-5 year commercial supply agreement. Validation is still classified as development for us.
But that is higher margin business.
The FDA accepts it. Sorry?
I said validation is a higher margin business compared to other developmental projects that you would have.
It's the most expensive piece, yes, because you're generating all the data that will put a boundary around the process as it goes into commercial. So that is the one which requires the most resource, the most time and effort, and therefore attracts the highest price and the highest margin, because it's the most difficult work, frankly speaking.
Got it. Thanks very much.
Thank you. And good questions.
Thank you.
Thank you. The next question is from the line of K.V. Narayanan from IDFC First Bank. Please go ahead.
Thank you. Thanks, Harshil. Thanks, Mr. Majmudar. My question is, if you were to take out, what would be the amount or the quantum of non-cash items in the present result, if you were to take out whether it is the one-time, issue or any other non-cash FX-related, translation-related kind of costs or impact? That is the first question. And the second question is, by when do you see the Bavla facility fully functional?
Hi, KV. So as far as the first question is concerned, the non-cash items would be one obviously related to the depreciation and amortization. Second would be the forex impact on an annual basis, which was close to about 32 crores. And the third would be the deferred taxes, the deferred tax liabilities that we have on the P&L. So this would be the main items that need to be
accumulate all the items, then what would be the cumulative impact if you were to approximately hazard a guess?
As I mentioned earlier in my presentation, the cash profit for the full financial year comes to about 278 crores.
Okay.
So, that's the cash profit that we generated for the full financial year.
Thank you. And thank you. And the second part, Bavla, by when do you think that gets online?
So Bavla, what
online?
Yes.
What we are doing is basically because of the impact of the audit and with the lack of manpower, since we have done a massive restructuring, we are one by one reopening the plants according to the need based by the customers and the priorities that we give to the customers for the CRAMS projects. So until now, we have opened up 2 plants, which is Unit 8 and Unit 6, which is catering to our internal subsidiaries as well. In a major way for one of the biggest molecules at the subsidiary level. We make intermediate for that, and we are catering to some customers' key starting materials as well. I think that is the most easiest to do right now without having the approval of the regulatory. On the API side, as mentioned earlier during the introduction as well, that we are working with individual clients to allow them do virtual audits and help them get approvals from the local authorities, which is higher than the EDQM per se. And if they have the approval from the local authorities, they can give us the approval to manufacture the APIs and start. For that, we have gotten the approval of almost two companies. One of which is a major one, and we have started manufacturing. Started the manufacturing activities for the key starting materials, and then soon the API in this quarter, for which they require the module. So that is another unit 2 which we are starting. Post that, we have 3 more units to restart, which will be done in a periodic fashion as and when we are ready with the people at the facilities, which we are recruiting, and post them being trained, the remediation plan that needs to take place of each plant before starting, and of course the regulatory approvals by the customers from their regulatory local regulatory bodies till we achieve the EQM.
Thank you. Thank you.
Thank you. The next question is from the line of Nishit Shah from Ambika FinCap. Please go ahead.
Yeah, hi. Thanks for the opportunity. Last year's annual report talks about your pipeline in antibody drug conjugates, and last year we saw at least 4 multi-billion-dollar global deals in ADC. 2 were done between AstraZeneca and Daiichi. One was done by Gilead buying out for $27 billion a company predominantly into an ADC, and Merck's deal with Seattle Genetics. Can you put some color on these, given the fact that you have a big ADC pipeline globally?
Yeah, I can put some colour on it, but I don't talk about clients. But 3 of those 4 clients are, I should say, known to us. And we are actively involved in other clients as well, of course, both big and medium-sized pharma in linker payload and conjugate work. So, yeah, I think it would be easy for me to talk about clients, but then I will work across our confidentiality agreements with clients, and we appreciate pharma industry is very competitive. So, yeah, all I can say to you is that those customers are known to us.
We have a very large ADC pipeline. Globally, I understand there are at least 120 molecules in ADCs which are filed, and of that, 10% of the pipeline, CRAMS partner has been Carbogen Amcis. So can you throw some color on that, Mark, before I move on to another question?
Yeah, it depends how you quantify the value of the pipeline, because we're working on one antibody, one linker, if you like, for a large company, and that linker has got 4 or 5 different indications. We're working on another one for a smaller company in Europe, and their strategy is to license that linker. They'll use it for their own drug, but they're also licensing it to other customers. So in antibody drug conjugate, there's a lot of licensing deals going on. Seattle Genetics are a company that has a licensing model. They always have done. So they will develop linkers, payloads, drug, and then what they look to do is to partner with other companies, either doing a full partnership or licensing their technology. So there's an awful lot of activity in it, but it's quite diverse, and the business models employed are very different from normal CRAMS work that we do. There's an awful lot of licensing deals because of the cost involved, especially with antibody, which is very, very expensive to buy. So yeah, what I can say is that we're involved in quite a few projects, either at the antibody-drug conjugate scale, ADC, full ADC, or doing the drug and the conjugate, the linker. So, we have linker payload work, we have linker work, and we have antibody-drug conjugate work. The only thing we don't do is the antibody itself. And the thing about the value of antibody-drug conjugates is 60% of the cost of that drug is the antibody, and we don't make the antibody. So that's a large proportion of that number you're talking about is related to companies who are manufacturing antibody, biologics companies. And that's an exceedingly expensive business to get into, and therefore quite a costly thing to buy. And that's something we are not involved in. Does that help you a little bit?
Yes, definitely. I understand your limitation on not able to speak on the deals or specific clients. But would you say that we are one of the leading players on the ADC space at this point in time, given our early start on the subject?
Well, I wouldn't have said we were the early ones. Long-term Piramal were the early ones. We came in the second wave. We were one of the first in high potency, but one of the second wave of companies in drug conjugates, antibody-drug conjugates. Difficult to rank us. I would say that, as I said before with the previous question, the linker piece of it, which is the most complicated bit, is we're one of the best in the world at that. We have a lot of capability, a lot of experience in that area. We are one of the best as it comes to handling potent compound across the world with our facilities in India and Switzerland. We are one of the best. But with the antibody, we're slightly less experienced. Okay? So we're not number one, number two, number three. But what sells us as an antibody-drug conjugate company is all of the other capabilities we have. That's the one thing that not many other companies have, which is the ability to pretty much make everything. As long as it's chemical, we can make it.
Yeah,
that's one of the things that sells us.
That's very useful, Mark, and very heartening to note that we are leaders in linker technology, which is really cutting-edge technology. My other question is on vitamin D analogs, where you have been doing phase 2 trials. Now, what is the progress on that, and have we moved further from phase 2 to phase 3? Could you just elaborate a little bit on that?
Yes, I'd be delighted to. So, as I mentioned at the last con call, the trials have basically concluded for the two indications that we're looking at. And over this last quarter, the team, along with our partners, Boston University, have been collating all the data. So there will be a publication in the next couple of weeks, I'm told, by the team, in the American Institute of National Health, which is an emeritus publication, a peer-reviewed technical publication, where we will present the results and our conclusions from the results. As you will appreciate, I'm not at liberty to say how that panned out for us, but the publication will be out in the next 2 to 3 weeks, and we will then follow up with a detailed press release alongside Boston University. So, and I was hoping it was going to be out last week, and I was told it's another couple of weeks to get it into the publication. It's about the timing of when the publication comes out. So certainly at the next con call, we'll be able to talk about it very openly. But keep an eye out. It's the American Institute of Nutritional Health, and the publication will be out in the next week or so, I'm told. And it will be followed up by an appropriate press release.
So how will it help once we do let's say we get our phase 2, phase 3 done? As I understand, it's being sold as an OTC product in the U.S. market. But calcifidol, which is what I think we are working on, how can it help us in terms of improving our realization, and how does it benefit us?
Okay, it benefits us in a number of ways, and the trials are not focused on the same things. So one trial is focused on a small subset of patients who have chronic vitamin D deficiency. And that is an area where ARPIT and the rest of the board have been focusing our business going forward, looking at niche applications where their patients are just not being tended to. So that's something that as an organisation we want to focus our efforts on. Okay, patients of need. That will give us an opportunity to launch potentially our first ever medicinal product ourselves. We haven't finalised exactly how we're going to deal with that yet, but that's one option. And we've already manufactured product out of Bavla in soft gels for one of the other trials. The other trial is in COVID, and that one is on the premise that if you strengthen your immune system to the proper levels with calcitridiol, which gives you the opportunity to do it in a very sensible way, then you're already protecting yourselves against the reoccurrence of COVID. And the idea is that with a strong immune system, you may catch COVID, but you may not be admitted to intensive care, which is where the biggest risk is. Once you're in intensive care, your chances drop substantially of coming out. So that's the other one of the trials that we looked at. So if we can get conclusions to that, then that will stimulate our calcitridiol opportunity. And we have the capability to do large-scale manufacture of calcitridiol in our plant in India. So that could really stimulate it along with the manufacture of certain formulations like soft gels. So that's where the sort of longer-term plan is with these things. That's why we embarked upon these efforts.
Yeah, thanks. My last question is there any other co-investment opportunity on any of the big projects that you are seeing right now? Like the one which you announced, a $15 million co-investment by a Japanese company?
Yeah. I mean, that product has the potential to be the same size as our largest product that we've been making for a number of years. It has that potential. To be anything between a $15 and a $25 million project a year at maturity. And that depends on a number of indications that are currently looked at, not other ones that the customer may well be evaluating. So that's why we're so excited. And Arthur mentioned that. We really are incredibly excited about that one. And especially because it's from a Japanese customer, and they tend to be much more loyal, much more appreciative of the efforts. It takes a long time to get to work with Japanese customers, but once you start working with them, they are very supportive, very loyal, and great customers. So we're really excited about that one. We have another one, which is hopefully there'll be a press release fairly soon, which is, and I think we mentioned it in the investor pack, I'm sure, the hyperparathyroid drug. Well, that's another one which, again, has been an initial co-investment with a customer to help develop the product 2 or 3 years ago, to the point now where we're heading commercial with it. And again, they want to co-invest to create a facility or parts of a facility so that we can lock in supply for them. And again, it's a niche indication, but it's an unmet indication. And there's little competition in that area for that customer. So that could well be another nice project. But as I said to you before, and I've been consistent about this, because they're not our products, we're not doing market research on how much we could sell these products for. The customers are doing that, and we're relying on customers' forecasts. And they are as reliable as a British weather forecast, frankly speaking. I was promised sun today and it's raining. So, you have to learn to take the rough with the smooth in this business, unfortunately. But those two are very exciting projects. And if I were a betting man, I think we probably see quite a nice flow from the first one we talked about, the one that we put the press release out.
Yeah, thanks. That's very useful. And all the best to you guys. Have an exciting future ahead.
Thank you very much for your continued support and your questions. Thank you.
Thank you. The next question is from the line of Viral Bansari, an individual investor. Please go ahead.
Yeah. Hi. Am I audible?
Yeah.
Yes, sir, you are.
Yes.
Yeah. Thanks for the opportunity. Going by your presentation, it's very heartening to know that 12 of 16 projects have gone into validation phase. So my question here is, are these separate from the 7 already approved in the last 3 years, as Mark told me in the last con call? 7 are commercial, right?
No, they're cumulative. So this is for the year end. We've got 16 gone in. So that's how many we have in the portfolio today that are being prepared for validation now. In total.
There are a few which have gone into commercial, right? In the last 3 years?
Yeah, there's a couple that have gone. So the Japanese one, for example, that's now basically a commercial product, and now we're going to be manufacturing some commercial supplies right now in the small capability while we build enhanced capability to manufacture full-size commercial. The second one I was talking about with the previous investor, that's another one where we'll start to be making commercial supplies soon. So,
okay. So, what is the strike rate here? Like, how many of these in the validation phase can get commercially approved?
I think the low number would be half, and that's half somewhere between a year and 2 years from now, and it depends again on the timelines of the customers. Some of the validations will be relatively straightforward. Some of these that are linker payload and things like that are going to be very complicated validations. So I would say a low number would be 8, half of them.
8. So that's a pretty high strike ratio here.
Yeah, but don't forget that they're already in phase 3. So they've already had a lot of clinical trials done on them. The customers are reasonably confident that they've got a drug. It's whether or not other competitive companies can bring out a drug quicker. And that's happened to us a couple of times in the past, where we've been working on a compound, and one of them, famously about 5 years ago, AstraZeneca beat our customer to the market, and all of a sudden their market share opportunity dropped by about 70%. It's a competitive market.
Risk is always there.
Go ahead.
Yeah. So what is the timeline? I mean, yeah. Hello, can you hear me?
Hello. Yes, I can.
Hello. Yeah. So what is the timeline from validation to commercial?
Most of the time it's fairly quick, because some customers will commit to validation before they've got full approval. Most customers will not get full approval until we've got final validation documents, and then there's a submission stage. Customer has to get it in front of the regulatory authority and has to get it approved. Now, depending on the indication, for the FDA, for example, if the FDA are saying that this drug is a true world beater, then you'll get accelerated approval. And that could be anywhere between 6 and 10 months, maybe 12 months. If there's already a number of drugs in the area, and this one is the one we're working on is competing with that, then it might take longer than that. But generally speaking, most of the things that we're working on are things where there's an unmet need in some way, shape or form. And a lot of them are fast-tracked. But frankly speaking, these days, with the cost of developing drugs, everything's fast-tracked. So, we're generating data as quickly as the customer can eat it. And by eat it, I mean develop it into their CMC section and their submissions for their drug approvals. Yeah, and on the back end of this, you've got the formulators doing the same sort of work as well, frankly. So we're not formulators in full scale at the moment. We will be soon. but there's a lot of formulation activities that these customers are performing alongside what we're doing. So it's a huge amount of work. And all that data has to be pulled together into an appropriate submission. Then the customer's got to go to the FDA with it, or the regulatory body, and get approval. So, most of the time it's a year or so, I would say.
So, are you in any way indicating that we are going for a forward integration, like entering into the formulation space as well?
Well, we're already in formulation in France at a small scale, up to about clinical phase 1. We bought that business 10 years ago, and we're now in a position where we are now fully expanding that facility to small commercial scale. So we are forward integrating already. We've seen the opportunity. There is an opportunity, and construction is already well underway.
Yeah, but the real cream lies in the formulation being supplied to the innovator after being commercially approved.
Yes. So, and the other side of this is a parental sterile injectable facility where, or sterile liquids, I should say. So most oncology drugs are delivered in liquids. Antibody drug conjugates are all delivered in liquids. Beyond that also gives that capability, also gives us some capacity to do internal work as well on our own development projects, which, as I've said before, and Arthur said before, is a target for us, not just to become a service company. We're already a service company, but to extend our capability into a product company. And we have a number of internal projects underway looking at various things, including antipsychotics, controlled substances, contrast imaging agents, and things like that. And those will need formulation. So the project in France to expand the capability will also, in the longer term, help us to deliver those projects to the market as well. But initially, it's focused on fee-for-service.
And what I gather from your previous con calls is that when a molecule gets commercialized, an oncology product would give you, say, a 60% plus EBITDA margin, and a non-oncology product will be a little bit lower. So as the share of this commercial supply increases in your revenues, do you think there is an upside potential to your margins, EBITDA margins?
Well, we're always targeting an upscale in the margins. The fact of the matter is that we are a service company, okay, and we're in a competitive environment. So there's only so far you can drive your margins before you become uncompetitive. And that's a battle that we face every day of the week. Okay, is analysing what our competitors are doing and pricing ourselves appropriately. We do not set out to be the cheapest, and we do not want to be the most expensive, but what we want to be is the best value. We have a high cost base in Europe, of course, as you would appreciate. So one of the keys to this long term is to continue to leverage the capabilities we have in India and China to enable us to do certain parts of the project much more efficiently and effectively with scale and with the quality of the employees we have in those areas, and free up Switzerland to do the bits where price is less of an issue. And I'm not saying that we want to do things cheaply in India and China, because that's not the case. To do great stuff costs money wherever you are. The only thing that's done cheap is cheap stuff. Frankly speaking. So these are the things that we've got to continue to drive forward. But the game is always to increase our commercial revenue. We need commercial capacity. Once we've done that, we then need to increase our development capability to keep that 50-50 split, or the 60-40 split that we spoke about earlier. That's critical, because if we have too much commercial and not enough development, then the business is not long-term sustainable. If we have too much development, not enough commercial, then we're not generating enough revenue and EBITDA. So,
but Mark, even if you consider 50-50%, even if you consider a 50-50%, with the commercial commanding higher margins, there is always an upside risk to the margin, right? Upside potential to not risk, upside potential to the margins. The margins can improve from here. Obviously, it all depends upon the success of the molecules that are commercially approved.
Well, yeah, it does, but it also depends on the amount of time, labour, and what you have to do to bring more work into the pipeline. So we've increased development capability. Over the last 2 or 3 years, we've been increasing development capability. What you see as a result of that increase in development capability is 16 products in validation. That's never been done before, but we've needed to invest in bringing more chemists in, more scientists, more analysts to plow through this work. Okay? So now it's translating into there's a chance that these are going to go commercial. That means we now need commercial capacity, so we have to create that.
Yeah, that explains a lot.
And it's a cycle that we go through in this business.
So from what I gather from what you have said is that if there is a potential of 8 molecules going commercial out of the 12. Just a potential, a hypothetical potential here. Okay, and with already 3-4 of the molecules gone into commercial phase in the last few years, I can sense your excitement and why you guys are so excited. That is what I was trying to understand by asking you questions.
Well, the first thing is, and that is why we are investing in such a major way, in Switzerland. Because if you consider even 8 going commercial, there is no capacity in Switzerland to manufacture them, and it was instrumental for us to invest in API facilities as well to ensure that these projects that are going into validations and when they go to commercial, we are able to capture them to manufacture them. Otherwise, they would go to someone else.
Yeah, is it possible to get some part of the work done here in Baula because that would command higher margins?
Yes, it would not command higher margins per se, but yes, for sure, all of these projects have a potential of interlinking all our facilities, not just India, but also China and to an extent even Manchester, where we are always going to be all of these clients in the first place are coming to us because of our wide location base where their risk mitigation is becoming getting catered to, and for the expertise that we have in terms of oncology molecules in particular, which they really want to use in both the locations of Switzerland and India. There are some clients, of course, who do not wish to come to India at all, but that is not the majority of the bunch. The majority of the bunch, they do want to come to India and they like the idea of de-risking themselves within the same company, but at a different location.
Oh. And Arpit, we are already supplying some APIs and starting materials to Carbogen Amcis from India.
Yes, exactly.
Yes.
Okay, so it's an entire
value. That is always so. That's absolutely it's called technology transfer, and we have to optimize the available infrastructure and facilities everywhere for cost control and effective penetration. That is always there.
Exactly. And well, by coming back to your earlier questions of the revenue, I understand what you're trying to think of, and in terms of commercial, if the commercial is larger, then the sustainability increases. But if I try to put it as I think in a simple manner, that if you imagine that you have 10 people, right, and the 10 people initially are doing development work, which includes the validation. After the validation, the molecule becomes commercial. 2 of the 10 people are allocated for the commercial activities. Now we have 8 people remaining, right? Now the capacity of doing, the capacity reduces for doing development work, right? But they are managing with the 8 people. So now with the 8 people, let us say another molecule goes into validation and commercial. 2 more people are going to be allocated to the commercial molecule, the new commercial molecule. Now we have 6 people. Right now, the capacity will reduce further of them being able to do the development. So that is why the mix that Mark is mentioning is extremely important. That 50-50 is the bottom criteria. If we go below 50-50 mix, then it becomes a dangerous scenario in terms of the capacity being underutilized when it comes to development work, manpower being overstrained when it comes to development work or commercial work. Something has to get affected because of this. So we have to keep adding.
Oh, that helps, sir. Thank you so much. I mean, what I see from your explanation of your business is like your business has a tremendous long-term potential in a sense that there is a lot of potential to then go generic as well after the molecule goes off patent. So that gives a very high stickiness to your business. Obviously, we are not into the generic part, but in case if we decide to go into it in the future, we can. If there is a possibility, since we can also get an early mover advantage here.
Absolutely. Well, and again, bear in mind that what we tend to do is the difficult, hard to do things. And they tend to be smaller indications. They're not, 100 million tons of white powder being shipped around the world. So, we have a couple of products which we've been manufacturing for years, which are already off patent. But the cost of developing a molecule, redeveloping the molecule and submitting it for a generic company for the indication, it's just not worth it. So we continue to make money on those, even though they are essentially generic. Somebody could jump in tomorrow and make them, but the cost of making them, for the payoff for them, is just not there. So, there's an opportunity to continue to manufacture these products. One of the products we make, we've been making for 20 years. It went off patent 10 years ago. And we're still making it.
And the volume increased as well, post becoming generics.
Yeah, I still understand because Eprosartan
they found a different use.
Like take for example, Eprosartan, it got approved in 1996, and you're still supplying the API for it, I guess.
Absolutely.
Yeah, they're sole suppliers. Because it all depends on how well the customer has captured the market in terms of the patient pool that they've gathered and the trust that they've developed with the patients with the brand name that is associated with it. Right? It's like using an Apple phone, right? If you are using an Apple product, you will not go to a Samsung. It is like that, right? Regardless of how shitty Apple makes it or not, it is still you are going to keep using it. So it is that sort of a trust that these customers develop with the patients. So even if someone is able to come out with something possibly smaller or better in a different with a different product for the same indication. So patient pool, especially with the diseases that we are working on, they are so comfortable with what they've been using that they will not shift to a generic brand.
Yeah.
Yes, makes sense.
I'll give you an example. I'll give you a live example of what Arthur's been talking about. Fifth bullet point on the update on CRAMS on the presentation we put out. That product, 10 years ago, 9 years ago, I was in Japan with our commercial director sitting down and we had a meeting with the client. And we walked out of that meeting and we said, you know what, after all these years, and we've been developing and working with this project for quite a few years, after all these years, I think we're going to be saying goodbye to it. Customer didn't really seem to have any focus on it. They weren't predicting any growth and they were looking at moving away onto different therapies. That customer had a change of management. And within a year, they were ramping up sales for this product and they found new markets for it. And now we're manufacturing, every 2 years, we're manufacturing this extremely complex material, very expensive material. And we've got a market for it. We're not in control of that part of it. So we make for a fee. And the customer is responsible for his own registration, his own sales and marketing of his product. But sometimes things die. Sometimes you think they're going to die and you're wrong. They don't die. We were ready for generic competition on the product we started making in 96. We were bracing for generic competition. Never came.
Of course, human body itself is complex. So sometimes things we think don't work actually work. Okay,
yes,
so
exactly.
Fine. Thank you so much. That was a very comprehensive explanation. Now you are not the only guys who are excited. I'm along with you. Thank you so much.
Thank you.
Thank you.
Thank you for your questions. Thank you.
Thank you. The next question is from the line of Jigar Valia from OHM Group. Please go ahead.
Hi, thanks so much for the opportunity. My question is related to the ADC linker. Is it, and you mentioned that it's the most complex piece within the ADC. Is it the same thing which involves having your multiple 5 of your plants coming up together to develop the product? I mean, just to get a sense in terms of the complexity, is that something which makes it more complex?
No, I think it's probably, honestly, for what we do, and I've been kind of engaged in this most of my working career in some way, shape, or form. These linkers are some of the most complicated synthetic molecules that, and I'm only a chemical engineer, I'm not a chemist. And when I listen to some of our chemists and they say this is difficult, I believe them. Looking at the synthesis, some of these things are incredibly complicated and difficult to characterize. And that's why lots of customers come to us, because we've built a hard-won track record in this area. And we've got multiple sites that are involved in making linkers. And, it is not trivial. Chromatography is another one, which is an art, almost an art, I would say. In chemistry, there's an art to chromatography. And that's becoming more and more prevalent now as a commercial route to manufacture. 20 years ago, 15 years ago, that wasn't a commercial route for manufacture, but now it is, because drugs are getting smaller in terms of their volumes going to customers. They're more potent. Chromatography is becoming a commercial route to manufacture now. And we have a lot of capability in that area, trust me. We are one of the world leaders in deployment of chromatography to solve problems. There aren't many companies that have got more capability and more expertise than we've got. We're really proud of that one. That's been a core of Carbogen, since before it was acquired by the previous owner. So, it's founded on that. So yeah, we have some pretty smart people, and we have some nice equipment. And that's why customers like to come to us, because, we've got some experience. There's not too many things we haven't seen in some way, shape or form in the past. And that means we can put somebody who's already got some expertise on it in front of the customer. And that tends to be why customers come with us. Because, we don't just stand people like me in front of the customer. We actually get the chemist, and we ask the chemist to talk to the customer. And those guys really sell the projects at the end of the day. We're immensely proud of our capabilities in that area. Immensely proud. But what that means is, these aren't cheap people. And that's the same across the board. We've got some incredibly talented people in India and China. Incredibly talented. And our game is to deploy them in the best way possible for the benefit of the customer, and then hopefully that customer can benefit the patient. And that's the game here. And we want to make some money on the way. I would say ABC linkers and chromatography and hypo are the core skill sets of Dishman Carbogen Amcis, I would say. Globally. Core capabilities.
Thank you. We lost the line, so we'll move to the next question. The next question is from the line of Ashish Gulecha from Abbott Security System Private Limited. Please go ahead.
Sir, my question is, two questions, sir. One question is, in next 3 years, what is the pipeline, or what you should say, what is the estimate of your EBITDA top line and bottom line which you are targeting? Because that would be the target which you would have given to your team, and as well as you yourself would be keeping that in your mind. And my second question is, are you in talks with investment bankers to basically do monetary, what you should say, portfolio monetization with respect to API CRAMS now or in near future?
So Ashish, thank you for your question. So regarding the first question, taking a 3 to 5 year view, we can expect a top line growth of about 10-12% on a CAGR basis. From an EBITDA perspective, our target is to move closer to 30% as quickly as possible. So that would be more or less the target for the next 3 to 5 years.
Okay, that's fair enough.
Sorry, I didn't get your second question.
So second question, I was interested that whether with respect to the CRAMS and the API portfolio, currently or in near future, do you feel that there can be a monetization, or there can be, what you should say, some stake still? Would you be interested basically going ahead?
No, there are no such plans. I think there is nothing on the agenda for any kind of monetization right now.
Okay. Fair enough, sir. Thanks for the opportunity. Thank you.
Thank you.
Thank you. The next question is from the line of Ashit Kothi, an individual investor. Please go ahead.
Thank you, sir. I have some basic questions. One is, while due to COVID, our business has got affected, but at the same time, if you look at our employee benefit expenses, which is substantial, if you can throw some light on that.
So the employee benefit expenses, one of the largest expense or the share of the expense lies at Carbogen Amcis entities, and that's largely because most of the development work happens over there. And for that, obviously, we require people, the scientists, for doing the new product development work. So now most of these costs are denominated in foreign currency, largely Swiss franc, because Switzerland is the subsidiary where we have the highest amount of employee expenses. So there is a 10% movement in the employee expenses just on account of FX. So as compared to last year, roughly about 12% is, or about 15% is the increase in the employee expenses. About 10% is related just to the FX difference.
Okay. So going forward, how do this cost increase would be substantial, or the sales would be much better compared to the employee expenses?
I think on a constant currency basis, this might go up by about 4 to 5% on an annual basis. Having said that, with the new projects that we are expanding into, that will also require additional manpower. So we would have to recruit people, as we get closer to the commercialization of those projects, which would be factored into the additional margins that we expect to generate from those projects.
That would be in next 2 quarters?
No, not so the expansion that we are doing, that does not come to fruition until 2023.
Okay. And with regards to Bavla plant, what is the overall contribution of Bavla plant to top line and bottom line?
So as far as the India CRAMS is concerned, usually the revenue is, or in a normal year, which was FY20, the revenue contribution was about in excess of 300 crores. This is obviously after eliminating the intercompany transactions, and the EBITDA margin would be upwards of 40 to 45%.
So FY22, can we expect full?
Yeah. So as we move towards getting more operational activities in Bavla, we expect that the India operations revenue on the CRAMS side should be closer to 200 crores, 200 to 210 crores. And the EBITDA margins should be in the range of about 40%.
So basically, whatever the issues which were raised by the Swiss medic on Bavla, that has been taken care of, and we could be going at maximum capacity utilization.
Well, the capacity utilization can be much higher, which we would be seeing in the years to come. The observations on the Swiss medic are being addressed too, but that essentially does not impact the CRAMS side of the business. So as we mentioned earlier, we have already undergone certain successful customer audits, and we have already restarted the production for some of our customers on the CRAMS side. So when I mention about increase in production, this would be driven largely by the CRAMS projects coming out of the Babla side, as well as higher contribution of revenue from Naroda. So the combination of these two should allow us to achieve close to about 70% of our FY20 revenues. Hello?
Thank you. We lost his line, so we'll move to the next question. The next question is from the line of Deep Master from One Up Financial Consultants. Please go ahead.
Hi. So my first question was on the vitamin D side. So I just wanted to get a better understanding as to the purpose of the clinical trials, given that vitamin D as a product is sold, and it's also a branded product in many markets such as India. So I just wanted to maybe if you could explain a little better to me what benefit the trials bring to your product, and what the strategy would be. Would it be a branded product? Would it be a partner product? And sort of which markets you would target? Would it be domestic or an export market?
I think, first of all, let me take the markets, because if we're going to, our soft gel capability enables us to manufacture a straightforward vitamin D soft gels, and we have the ability to launch those in domestic markets if we wanted to. Our focus on our trials is global markets, looking at global issues. One of them is COVID, of course, and looking at strengthening the immune system. And there is a lot of evidence to say that strengthening the immune system in COVID patients prevents them moving into intensive care. And if you do not move them into intensive care, then there's a chance that there's a better survival rate. That's what we believe will happen, and we're waiting for the publications to come out, and then we'll be clear on that. The other one is the obesity side, and again, that's a global problem. And these patients are a small subset, but they suffer terribly from a very poor immune system, which means they're open to other disease because they're not metabolizing vitamin D through sunlight, through the skin, through the renal system. So the addition of our product will negate that problem and go straight to strengthening their vitamin D levels, which means that their immune system is much stronger. So those are the two propositions. They're global issues. And what we're hoping to do is to be able to get approval in the long term to manufacture these products. Now, how we manufacture them, whether we do it through partners in various territories or we do it ourselves in other territories, that's not clear to us yet. We haven't made those decisions yet, and frankly, we don't need to at this stage. It's one step at a time. So the first step will be the publication of the results, and then we'll start to look at the second step, which will be what do we need to do then for phase 3 trials, or what do we need to do in certain countries to get this approved. So that will be the next step, and once we see the data, then we'll have a much better understanding of how we deal with it. What I will say is that for the vitamin D business, like any product business, what we've got to do is to continue to innovate, introduce new products to freshen up the product line, because once you've got a product, there's always somebody who wants to jump in and take some of your market. And the way you attack that is not just lowering the price. The way you attack it is to innovate and introduce new products and things where customers and clients have a need. And we're constantly looking for that now. And that's become, since Arctic's basically taken over the lead of the company, that's been the focus for us. Not just sitting back and saying, well, we've been making this for 25 years, we're the best. That's okay, but we've still got to bring new products in to excite customers. So that's been a focus for us, and that's what we're doing with that business. The vitamin D business is a perfect example of that. There's a mature side of the business, but the analogues really have some interesting activity in various areas. And pharmaceutically, our vitamin D, we've got about 40% of the market of pharmaceutical vitamin D. But you've got to remember that the market is about 20 kilos, the world market. So these are very potent products. It's not like the feed industry where we're making many tons of vitamin D to feed shrimp. We can't compete in that business. The Koreans and the Chinese and the Vietnamese have that business, and they're welcome to it because it's a race to the bottom. So cosmetics, pharmaceuticals is where we're focusing. For better margins there, the better needs.
Hello? Yeah. So Mark, my question, I understand the indication. My question was more about, if the trials are successful, does that give us, sort of any edge on actually getting our vitamin D approved for these treatments? And then would it also, so does that not automatically enable your competition to also use their products for the same indication? So what's the edge we get with the trials? I'm just trying to understand that. Is there any patent protection? Is there some specific formulation that we've developed that will be hard to kind of, get around in terms of patents?
Yeah, I mean, the COVID one is going to be a huge one. And even if we captured the entire COVID market, we wouldn't have the capacity to manufacture. So, we've got to be realistic. But on the other side, with these niche indications such as obesity, if we get a march and we get in there first and quickly, then there's a chance we're going to be able to dominate the market a little bit because, you're first. So that's our proposition, is not to go for these massive indications where there's tons of competition, but to look around and say, where are there patients of need which are completely unmet because Big Pharma doesn't see them as a market? Well, Big Pharma's cost base is very different from ours, so we might see that there's an opportunity there for us. And most importantly, we're treating patients, people who are suffering, which is another philosophy that we've adopted over the last few years in the business. What we do is helping people, and if we can help people and make some money, then that's a really good thing to do. So that's where we're focusing. So we're deliberately not going into areas where there's going to be tons of competition. One of the big players in vitamin D is a company called Garden, they're Chinese. They're probably not going to worry too much about little old Dishman Carbogen Amcis Limited, serving a subset of maybe 250,000 patients or something. Maybe they are, maybe they don't. But our strategy is to go and look at those niche indications because there's less competition there and there are patients that are going to get no help from Big Pharma.
Okay. And my second question was just a clarification on Babla. So, from what you say, it seems that you're largely done with the remediation. And now it's just a matter of you getting customer approvals once we get approvals from their local authorities. So is that understanding correct?
How it would work would be that first we are talking, so we are on a daily basis talking constantly to the customers and the needs, and they are constantly discussing with us of the kind of stock they have remaining and by what time they will require the products and etc. To try and figure out what is the best timeline to fit them in for the production for the production of their molecules, and in which facilities was it being made. So what has happened is that due to DQM, all the facilities in the beginning we had to shut down completely. Then with the remediation plan, according to which were catering to the CAPA, majority of the issues that were raised by the DQM, we had made a remediation plan for each and every plant, not all together, but for the first plant, and then we did the remediation plan, and then the first product went in that plant after doing the remediation plan. Then the other customers, we started to talk to them, and as and when we started to get the green light from the customers, we evaluated the plant that it was being manufactured, and we did the remediation plan of the second plant. Similarly, with the other customers, where we are going to be opening up, slowly and steadily opening up one by one plants, one after the other. It is not that we do the remediation plan for every plant together and then do it. We are doing it customer-specific, product-specific, SOP-specific remediation plans to ensure that when the EDQM comes, there are not going to be any challenges when they audit this. It is not as simple as just opening because the customer has gotten the approval, we open the plant and we start manufacturing without a doubt. No, because the plant shutdown was due to the result of the audit. We have to make sure that we are taking all the necessary precautions as to when the EDQM does come for a proper general audit. What we do right now is not going to affect the customer or their supply in the future.
Understood. That's very helpful. And just lastly, I just wanted some further understanding on how the mix of business could look in the near to medium term, say, the next 2 years, given that we have a much larger pool of drugs that are potentially, that have the potential for commercialization. And, many of them could be large ADCs, which could be, multi-million-dollar opportunities for us. So does the mix potentially tilt a little bit more towards commercialized molecules in the near to medium term?
In the near term, yes, for sure, because there will be a rise in uptick. So if you are just comparing by the revenue-specific items, then in the near term you will see an uptick in the revenue due to the commercials, due to the commercial molecules increase in volumes. But that uptick will have to be then worked on to make sure that we are increasing on the developmental revenue as well. So in the mix of the overall revenue will go up together of the development and the commercial, not together at the same time, but eventually the development revenue will have to match in terms of the percentage of the mix, which was explained by Harshil and Mark and myself again, of the bare minimum of 50-50.
Yeah. I think this
that will enable you to take. Sorry.
Well, it's a cycle. It's a cycle. You see, right. So if you go back to 2000, okay, we had a lot of production capacity, and we couldn't fill it because we didn't have enough development chemists. So we brought more chemists in, and over the next 5 to 8 years, we filled that production capacity. At that point, we needed to start to think about creating some more production capacity. So we did some modifications and things. This is pre-Dishman acquisition. When Dishman acquired the business, we had just finished doing some additional development expansion. Okay? So over the past Dishman's acquired the business now 15 years. So in that 15 years, what we've been doing is we've been doing incremental small increases in capacity for production and development. We are now at the point where we have done pretty much everything we can do to squeeze in more production capacity. Okay? Now we have to expand. And we pre-announced, I think, when did we do that announcement on the 2 large projects, Ashurban?
You mean on the EDC?
On the expansion for the Newland project. And
the expansion. That was in August or September. Yeah.
August or September. So what we need to do now is to do a proper increase in our production capacity based on our pipeline. And we could be criticised, okay? Quite happy to be openly criticised that we should have been more predictive. But the problem is with this business is we look at 16, it could be 8, it could be 5. I don't think it will be 5, but it could be. So we have to be cautious because building capacity is expensive. So what we've done is lots and lots of incremental changes. So 4 or 5 years ago, we bought a building. We fitted it out with some additional capacity for development. That enabled us to fill our manufacturing capacity in high potency. But now we're full again. So we have to have more production capacity. So it's a cycle. So the next cycle now is we've got some incremental projects that I said we're doing right at the start of the discussion. And in 3 years' time, 2 to 3 years' time, we'll have the large facility completed, and that will be just about in time to go with commercial volumes of a number of these projects, and it's a weighted assessment. Because we're at that point now where we have so much confidence that a number of these projects are going to go commercial, because the pipeline is so strong, we either have to invest or we have to accept the fact that we're going to lose some of these projects, and we don't want to lose them.
Right, that's very helpful.
And then maybe 3 or 4 years down the line, we're going to have to add more development capacity again, right, to keep the production capacity moving.
Understood. So Mark and Harshit, so the amount of, we have about 200 crores of CWIP on the balance sheet now. So is a large part of that for us ramping up our production capacity? And is that coming up in Switzerland, if I'm understanding correctly?
Yeah, so most of it is related to the expansion in France and Switzerland.
Understood. So basically, if I understood this correct, as our mix sort of tilts towards more commercial molecules, we'll free up some development capacity, and that will enable us to kind of take on more projects, and over time the mix will kind of get back towards 50-50, which let us keep our cycle going.
Yeah, 50-50 is the ideal. It's the ideal. Goldilocks and the three bears. It's just right. But the reality is that it drifts between 40-60, 60-40. And we're not uncomfortable at that range. If it drifts outside that range, then we start to get worried. So that's one of our key metrics we look at, is the split commercial development. That's a key metric for us.
All right. Thank you so much. This is very helpful. Thank you.
Thank you.
Thank you. The next question is from the line of Sanjay Chaudhary from Tata Capital. Please go ahead. Sanjay Chaudhary from Tata Capital, your line is in the talk mode. Please go ahead with your question. We would request you to unmute yourself from your mobile and go ahead, please. Due to no response, we'll move to the next question, which is from the line of Sajal Kapoor from Unseen Risk Advisors. Please go ahead.
Yeah, hi. Thanks for the follow-up. Question regarding our consolidated fixed asset turns. So when we look at our Lonza or a Catalent, the typical asset turns are in the region of 1 to 1.2, as both the capex and the opex are higher, much higher in developed markets relative to, let's say, India or China. So given the fact that majority of our asset base is outside India, Europe mainly, what kind of fixed assets turns that is we normally aim for? So for example, if we deploy 100 million in Switzerland or France in the gross block, what's the sort of target sales we can achieve when fully commercial? The reason I'm asking is because my sense is that for any CDMO player like Lonza, Catalent, or even Dishman Carbogen, where the majority of fixed asset is outside India, it would be difficult to achieve an asset turn greater than 1.1, 1.2 when fully commercial.
Yeah, so Sajal, you are absolutely right. So the way to look at the capacity that we put in and the resultant fixed asset block is to kind of divide it between India and the overseas entities. So overseas, since most of the work, or at least 50 to 60% of the work, is allocated to development versus commercial. And if you make a comparison to, Lonza would be quite big, but even some of the other players in the European region, and we actually did that. We have seen that the asset turns are close to about 0.6 to 0.8. So, it would be difficult to imagine an asset turn greater than 0.8 as far as our overseas entities are concerned. Having said that, as far as the current expansion, which would happen in France, is concerned, which would be largely on the commercial side, we do expect that the asset turn could go up to around 1.1 or thereabouts. As far as the India capacity is concerned, as we keep on filling up our existing capacity with more products on the CRAMS side, we can see an asset turn of close to about 1.5 to 1.75. So, on a consolidated basis, I would say it could be close to about 1 to 1.1 as an average.
Yeah, so Harshil, I completely appreciate that. So if over a period of time, once the molecule is commercial and it's stable, and we do a tech transfer from, let's say, Switzerland to India, is it not fair to expect an asset turns of somewhere between 2 and 3 in complex intermediates and APIs? Because if you look at a Suven Pharma or any other player who is into mature molecules that are patent protected. So I'm not talking about the molecules that has just gone commercial, because the ramp up takes 3-4 years. But I'm talking about the molecules that are commercial over the last 5 years or so. So they start gaining traction in the market. And then what we have seen is that companies like Suven Pharma, they typically get an asset turn of 2.5, maybe 3 as well, in those sort of specialty molecules.
So, Sajal, the kind of work that we do, is largely for the NCEs as compared to generics. So, yeah, I mean, even if you look at India, we also have certain development projects that we do out of India. So not all of the capacity is going to be devoted just to commercial. Yes, the thought is very clear to get more projects into India, but that would take time to fill up the entire capacity that we have between Babla and Naroda. So that is number one. Plus, what we also need to factor in is that the expansion that we are doing now, that would kind of last for the next maybe 6-7 years. And maybe in the 4th or 5th year, we would have to again start thinking of additional capacities, assuming that, our development pipeline is extremely strong. We still see that, there could be a lot of new projects that could be commercial. So, having said that, not all of the capex could be put to use at a particular point in time. There would constantly be a capex that would be required for the next phase of growth. Hence, on a consolidated basis, taking into account all of these factors, I think around 1.1 is kind of an ideal turnover ratio for our particular business.
Sure, Harshal. Thanks for that clarification. Much appreciated, and all the very best. Thank you.
Thank you very much.
Thank you. We'll take one last question from the line of Jigar Walia from OHM Group. Please go ahead.
Hi, thanks for this follow-up opportunity, and thanks for the long call. First is a follow-up to the previous question. So just to clarify that while asset turns could be lower internationally, is it fair to assume that the win rate or the strike rate is a little better with regards from clients or regulators?
Yes, you mean in terms of getting the project?
Yes.
In India?
No, just getting the client to do a project. So having a capacity, I'm looking at the capacity that is coming up in France or Switzerland and versus Babla. So while Babla may give better asset turns, but it's probably more likelihood of striking a favor with these clients if we have a facility in Europe. Or with the regulator itself, given Swiss is a regulator.
So in terms of getting the business from the customers, yes, our strike rate, and Mark, maybe you can also elaborate on that. Our strike rate has been pretty good. And as we have also mentioned in our presentation, we are seeing a significant increase in the number of inquiries over the last 2-3 quarters, which has increased by almost 11% as compared to what it was earlier. So I think from inquiry to project conversion, our strike rate has been quite good as compared to the industry, and that is one of the reasons why we have so many molecules for development across different phases. Plus, I would say about 70% of our business would be repeat business from the customers. So, that also helps a lot because of the strong relationship that we share with our customers.
Understood. So the selling proposition with regards to a Babla plant would be diversification rather than cost arbitrage or cost saving, primarily.
We were very much customer specific actually. What happens is that, so even historically, if you see, we make many of the key starting materials and intermediates for our facilities in Switzerland and Netherlands. Is more to do, so one is to do with debottlenecking the facilities to allow less investments to take place, or less quantum of investments to take place. But if that option, once that is exhausted, then what happens is also the customer is requiring, once the molecule is launched, the price would be at the highest value or the highest per kilo value, which eventually would, as the volume goes up, the customer would require it to be wanting a bit more discount or concession. There is a facility in Switzerland, for example, which are all CGMP facilities. To make something which is not a CGMP step is actually spending a lot of resources on something which is not required. So that step comes, if that sort of step comes to India, then that not only spares up the CGMP capacity where Switzerland can do more molecules, which then it will allow them to give a reduced price to the customers. Provided that the customer agrees that this goes to India for in the non-GMP manufacturing kind of a scenario.
Understood.
If the customer further wants a concession, then what we will have to push is to then we will have to get some of the CGMP work of the API also done in India, which is as equal or even better facility than the current facility of Switzerland. If Switzerland was responsible to make the facility in India, they have made it better than from what the experience that they've gained of the oncology facility. So the customers are well aware of this transition of what is required in terms of when they desire a lower or a discount on their molecules, where we start to push them to start coming to start doing joint kind of manufacturing between India and Switzerland. That is the kind of direction that this company is heading to, where Switzerland becomes a kind of the front for doing the development work, early phase work, development work, even for in some aspects for transferring to India eventually after doing the validation and tech transfer. For that we need enough and more molecules to be made there. All said and done, if it is a low volume, high value product, the customers will not be fully convinced to go out of Switzerland. If the volume is increased and it is beyond the capacity of Switzerland to manufacture, then it will for sure be coming to Switzerland, to India.
Very well explained, sir. So my next question is a follow-up to my earlier question on the linker. Unfortunately, I got dropped off right after asking the question, but I'll look into the transcript. Now, my question is, so you're very strong on linker side and you're great on the cytotoxic side of it, on the onco side. And we have some reasonable thing on the MAP side. You also mentioned that while we're slightly weaker as compared to peers on the MAP side, but we can do the conjugation piece. So is conjugation also very complex and difficult, and or do we have any growing capabilities on the finished product side?
I think it is all it works with it is two pieces of the same pod. So linker is the most complex piece. I may give you an analogy which I may regret in the future, but it is apt. Think of it as a scenario of a suicide bomber, right? A suicide bomber is there and he wants to go to a bomb parliament or somewhere or PMO office or something like that. For that, he needs a car and he needs a bomb, and he himself is a linker. So now this bomber needs to be highly intelligent, highly complex to go inside the PM office or inside the parliament with the bomber or with the bomb on his back to ensure that he is going inside undetected, have a communication, sit next to the Prime Minister, etc., and then at the speed of the take out the tag and bomb itself, right? This is how complex this is the analogy that could best come to mind to as simple as level of how complex a linker is. So linker complexity is the most complex piece. Then comes the conjugation, where we are already one of the top players in making the payload or the bomb, for that matter, when it comes to the killing the cancer cells. We can make the payload in a certain way which gets attached to the linker. So what happens is that the linker will then it has to drive the car to the specific location of where the cancer is, and then link itself on that same location for the payload to go off.
Understood, sir. Thanks so much for the example also and the explanation. Okay. Next is, you alluded to a lot of licensing deals happening within the ADC space. So that is it that somebody having all the capabilities on the cytotoxic side, on the linker side, map side, conjugation side, if pieces blocks are missing, then also the deals can happen, or having everything in one place is actually remains a very significant advantage to any player?
Look, the licensing things that happen are usually the customers' preferred option. But what usually these customers do is that how and why they license out in the first place is due to the players like us, where they get the development done. So they might work on the initial development, and then they would let us say a development on paper that this is how it should look, whether it is possible to be done or not, and they would come to us, and then we would be putting our chemists on it, whether it is possible to be made. And if it is, then we would supply the material to the customer. They would do the clinical trials and then do their patenting. Where after that they would license it out to other players. So many of the customers who are doing the licensing deals, they don't really have in-house manufacturing capabilities or expertise. So they, not all, some do for sure, but not all. So they rely on CDMOs like us to do this sort of work for them. In this case, since the complexity is high, and even otherwise, even to be able to get everything done from at a single location is always going to be lucrative for the customer. Because if you think about it, if you have to get a linker from one person and a payload from the other person and conjugation done by the third person, where the antibody is coming from the fourth person, then it will be like the scenario like the Airbus. I'm not sure if you are aware of that incident, that what Airbus decided to do is to get the components made in different parts of in different countries. Different components were made, and all components would then be brought into France and then put together. And when the time came to do that, nothing fit together. Right? The chances of that Airbus kind of a scenario increases. So of course, when there is a race to come out with such molecules as quickly as possible, to have a one-stop shop for the entire thing is always preferable. Antibody we don't make, and hence, but in the case of antibody, it is not considered to be a one-stop shop solution, because the antibody need not be the complex part. The antibody is just a car that needs to drive to the specific location where the experts are already there and they are making it. So we in that also we help the customers evaluate the antibody which is specific for the indication, and then help them do the conjugation. So in all of this, There is a lot of documentation that needs to be done, lot of analytical support, during the clinical trials, etc., needs to be done. So to do it from different companies would create a mayhem. And if it is a single company which is all joined together, which are all having the same people working on the same thing together, the flow of documentation in terms of regulatory, etc., is also the flow becomes much smoother for them. So yeah, and that is one of the major reasons for which we are expanding even into our formulation capabilities, where one of the things from there is to do contract formulations. So essentially what will happen is that this decal will become a one-stop shop for your entire molecule, right from preclinical levels to the formulation of the molecule from phase 1, phase 2 levels, and to manufacture the formulated molecule for the entire patent life. So and we will possibly be the only company to be able to do that in the whole world.
That's very, very heartening. And so which all plants get involved with regards to linker and conjugation?
The linker and the conjugation happens in France because it's a formulation piece conjugation, but the linker is being developed in Switzerland, developed and manufactured in Switzerland.
Perfect. So just last question from my side, just a clarification that the full-scale ADC IND filed with FDA and the approval, that's for a client, right?
Yeah. So yeah,
it's not our own filing, right? It's for we are not into own filing, and we are pure clients. That's the bigger.
One more, you were saying something.
Hello, can you hear me?
Yes. Yeah.
Am I audible?
Yes, Mark.
Oh, sorry, I got dropped out of the call. I've been trying to get back in. Sorry, could you repeat the question very quickly?
Yes. My question was the full-scale ADC IND filing and the approval is for a client, right? It's not own IND filing, and we don't intend to get into IND filings, or at some point in time we may have some plans to diversify from clients.
We may have some plans to do that, but no. This is the main focus is contract research and manufacturing. Yeah. So it's a customer.
Got it. And if you get into own IND, then it would be monetizing at whatever phase 1, phase 2 at some point.
Well, if we get into an IND, then it depends on what the indication is. Depends on the patient population. We'd have to do a full costing of cost-benefit analysis of it. But that's not in our heads right now for medicinal. But we are looking at conjugations for other products, but not for medicinal products at the moment.
Thank you so much, sir. Thank you.
Thanks.
Thank you.
Thank you. As there are no further questions from the participants, I now hand the conference over to Mr. Arpit Vyas for closing comments.
Thank you all for joining the call and for your valuable questions, and of course for your undying support for the organization. The kind of questions asked, we must say that we really enjoyed it this time, and it was truly challenging for the mind, which is what we like. And we wish to continue in the same mode for the next call as well. Until next time, please keep safe, be safe, take care of your families, and with all our heart and well wishes for all. Thank you and have a good day.
Thank you.
Thank you.
Thank you.
Thank you. On behalf of Dishman Carbogen Amcis Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.